Last week we were talking options. This week we're diving in back to the technical analysis and market analysis concepts. So I will just real quick reintroduce for you all that have been to our sessions before or seen me or Andrew. We are part of the trading strategy desk. If this is your first time, we'll do a real quick brief intro of what we do and why we are hopefully part of your education journey to understand a little bit more about trading and investing in that process. So down below, you will also see a link to one of our favorite things to do, which is talking about much the same we are today, our daily market briefings. So our team, we have a group of individuals that are traders. We have background in fixed income and market making. We have backgrounds in financial analysis and technical analysis, which is Andrew and myself, our specialty. So definitely, if you would like to join us to these, sign up for these. They're a great way to get an introduction into what's going on out there in the markets, what kind of stocks are moving or indices, and we've got the macro environment. We do it all. It's something that even if you don't feel comfortable with it, we keep things on just a real level where we are trying to level with you and talk about these ways in a way that you can understand it and give you some of the explanation without the typical maybe sales pitch or that you might hear on some other areas or places. You'll also see we do have options sessions. We have trading tools and basics, and then a technical analysis. If that's part of your journey, definitely, again, join us for these. You can find us at fidelity.com/, that's the one with the question mark on there on that little key, /coaching. We also have our classrooms where we do some of these same topics. So trading strategy desk classes. If you want to walk through maybe the learning of ActiveTrader Pro, which you'll see a little bit of today, options for beginners or intermediate, technical analysis, taking you through that process of building the foundation of the science and art that is technical analysis. Speaking of today's topic, technical analysis for today's markets, myself and Andrew, both chartered market technicians, we are excited to sort of give you some of that context and background to maybe how somebody comes up with a process of thinking about what's going on out there while also analyzing the markets. Both of us have talked to clients and been educators now for a long time and have seen what oftentimes works, what doesn't. And so we're going to try to impart some of that wisdom on you. We'll also be coming at it from top down and bottom up analysis. So my process, and I'll get into what my process is or how I was trained effectively from what's called a bottom up look. Andrew will be taking the top down. He'll start walking his way. I'll start walking mine, and we'll meet in the middle as the country song goes. So I will, without further ado, hand it over to you, Andrew. Let us get started here. Talk about what's going on out there you see in the markets, and definitely introduce yourself.
Hey, absolutely. Happy to be here with everyone. Like you mentioned, there's a variety of different ways that people can use analysis in their trading, how they arrive at a decision. Kind of the classical school of thought is some sort of component of fundamental analysis. So what is fundamental analysis? Well, it's the concept of evaluating markets, evaluating companies from the perspective of, well, what does this company do? How well do they do it? How does that position them within the broad markets? And what does that mean from an investable opportunity perspective? And by all means, like we mentioned, that tends to be the classical approach. If you went to a business school, if you evaluate just companies in your local markets, if your friend wanted you to invest in their pool cleaning company or something to that effect, those would be the questions that you would generally ask. You would ask, how well is this company doing? What is the revenue? What's the market share? Things to that extent. And kind of like Jonathan mentioned, we can generally categorize most components of analysis within those broad spectrums. Is it a fundamental approach? Is it a technical approach? Is it a top-down or is it a bottom-up style? It's kind of almost like a two-axis style quadrant in that respect. How are we combining those different forces? And like Jonathan mentioned, both of us tend to gravitate to the technical analysis world. Now, why is that the case? Do we think that we're more correct than others? Not by any means. If anything, it's kind of the exception of understanding what the market dynamics are at that point in time. Because at least for my own experience, what the original draw for technical analysis was for me was this thought process. Well, hey, as far as fundamental analysis goes, we tend to look at all of these news items, the digesting of different opinions that are out there. And most of these people that are putting out these opinions are people from, the Ivy League educated business scholars in that respect. And they're paid the big bucks to analyze these companies. And when we think about the multi-trillion-dollar markets, how are we to compete as individual traders in that respect? Who am I, state school graduate, to say that this fundamental analyst is wrong in that respect? Who am I to kind of think that the market is wrong at that point in time? Are they undervaluing something? Are they overvaluing something? And there was maybe a slight disconnect for me personally in that approach versus technical analysis, which kind of takes just the assumption that everything that can be priced into the market is priced in. And from there, we can observe components of trend in the market, components of supply and demand, and components of accumulation and distribution. So what do I mean by that? Well, technicians simply just observe patterns in the chart. We simply look for there to be trend within the marketplace. We look to see if that is something that we can take advantage of in periods of trend. And although that may seem simplistic, that is the driving force of assets at all points in time. Are people buying assets, or are they selling assets? Is there demand at any moment in time, or is supply drive the equation in the same sort of way along the way? And that by no means is something that we can predict. We can simply just observe and react accordingly. Technical analysis by design is not predictive. It is a reactive function of the marketplace. And if you're thinking that it is, say, the antithesis or the counterfactual of fundamental analysis, well, if anything, it's more so the expression of fundamental analysis, because there are traders who are willing to buy or sell assets, generally depending on their observation of what is happening from a fundamental perspective. Well, prices are simply the expression of those decisions being made. The people that are voting with their dollars at all points in time is expressed in the price itself. And that's, again, sometimes where I find the folly of fundamental analysis is, to some degree, is that it is the observation of what the market should be doing versus what it is currently actually doing. And that reflection of something that might be found in the marketplace. And to that degree, we can then add a variety of different, more granular components of technical analysis. It doesn't necessarily just mean observing what the S&P 500 is doing from a trending perspective. We can add indicators. We can look at other components of technical analysis, and then we can also use that same component of technical analysis on other types of macro-based indicators, macro-based indices, and things to that extent. On a quick kind of view of that, one simple way that we do this, no pun intended, is the utilization of simple moving averages. And to maybe even smooth out some of these to some degree, we can remove some shorter, longer term, and more different components that we find here. Because what are we ultimately trying to achieve? We are trying to get an objective output of what the price has done over this period of time. A simple moving average, all that it is doing is very simple arithmetic, and is adding up all of the closing values over a defined period of time and dividing it by those closing values to get a smoothing out of the price action. This is looking at charts on a weekly time frame, a weekly perspective, meaning that this gray line represents a 20-week moving average, a 50-week moving average, and a 200-week moving average. So we can get a quick view of shorter term momentum, intermediate term trend, and the longer term trend at that point in time. And that's the benefit that we get from utilizing technical analysis, both for a short-term trader, the people who may be day trading or swing trading, but also people who are managing a long-term portfolio, because we can use this to get an objective determination of what is the prevailing trend at this point in time. There's a reason that markets had reactions at some of these levels in particular. That first trend that I mentioned coming out of the 2020 timeframe Where do we tend to find those buyers on the dip along the way? Right around that 20-week moving average. When that first was eclipsed to the downside, that was our first warning signal of something potentially changing in the market. And that same move between getting below a 50-week moving average, where that also acted as a concept of sellers when we got back up to it. Essentially, the high of this move back in August of 2022 was right at that 50-week moving average, which pushed us down right to the 200-week moving average, where we found that final line in the sand. So in that scenario, we can see how buyers and sellers are using these levels in particular on a variety of timeframes. The same thing can be said during that time frame on a more daily perspective. The same concept of moving averages, except now for a daily perspective rather than a weekly perspective, can be found during that same period of time. Essentially, where did we find the original components of buyers or sellers interacting along the way? We found that same concept of resistance right at a declining 200-day moving average. So first and foremost, we can take the top-down approach of the market to understand what is the prevailing forces of the market at that point in time from a trending perspective, because we have to remember the market is, a market of stocks. This S&P 500 is just a way of getting an output of those 500 largest companies along the way. And in that case, too, we can combine that with other pieces of macro-based indices. I mentioned something to that extent, too, that we could combine it potentially with the NASDAQ. NASDAQ being that tech index in that respect, generally the NASDAQ 100, because what was a general difference that we saw coming out of that 2021 timeframe? Well, during this period, we saw the move between November of 2021 into the early part of January essentially be a lower high on the NASDAQ at this point in time compared to a higher high on the NASDAQ at that point, or on the S&P at that point in time. We see a divergence in that period where we start to see something underneath the surface for those larger tech companies versus the broader market. In that same way, too, we could apply general components of technical analysis, say, to a 10-year treasury note. If we think during a longer term approach, we've seen that accumulation of these bonds really accelerate during the last 5 years. Why, again, could that be the case? Well, we've seen a Fed tightening cycle, a raising of the rates along the way. We've also potentially seen demand for these bonds change in that respect, where that difference of coming out of the original inflationary or disinflationary cycle start to change in its paradigm. And we've seen the interest rate accordingly change significantly on those notes. In fact, too, if we go back out to a very long-term chart, well, we can see how different some of these levels have been at along the way, and how that move coming out of 2020 was a very long-term breakout of this deflationary cycle that we have seen going all the way back, in this case, to the 90s. And of course, if we had a longer-term chart for this TNX figure in particular, it would be even more pronounced. We could see this long-term trend begin to change during this period of time, or maybe just reverting to a slight area of normalcy. Some components of what we've seen here, just from a horizontal perspective, is how much time have we spent in this general 4 to 4.5 range on a 10-year note, this kind of mean reverting style move. And in the same way, too, maybe we use some component of the broad macro-based indicators of gold. What is gold doing during that period of time? We've seen another component in that same period that gold has had quite an accumulation cycle, that for the better part of this case 5 years, we can see that it had a hard time getting above this 185, 190 level until recently. It's been able to break out of that. In fact, too, funny enough, if we go back far enough here, you'll notice that this is actually the same level that it got to back in 2011. I'm sure everyone remembers what 2011 felt like as far as gold. We saw commercials about gold all the time and selling your gold for cash and things to that extent. And we were able to see prices mean revert for a period of time, get back to that level. And now we've seen a breakout of that. And again, what could be the reason for that breakout? Well, there's depending on how many people you ask, if you ask 12 different analysts, you might get 13 different opinions. And that's the component of what is driving the market at any period of time. And at the end of the day, it's buyers versus sellers. We are seeing more people buying gold at this moment in time versus selling. We're seeing demand outweigh supply in that respect, and the price is moving accordingly with that. And the question then becomes, is narrative driving price, or is price driving narrative? Is there a reason that we're seeing investors flock in to gold or other style of assets? So we can use this technical approach in the same way that we would observe the broad markets. We're looking for, is there a reason that people would be buying or selling assets at this particular level? Is there a reason that that happens at a certain price to earnings ratio or some sort of revenue figure? Did this level in particular hit the perfect price to earnings ratio on the S&P 500 that day in particular? Or was this where a declining 50-week moving average was, and there was more people willing to take positions off the table or initiate bearish positions because of the prevailing headwinds for the market at that period of time? So, of course, every decision being made in the market is happening for a variety of reasons. We cannot fully determine exactly why people might be buying something or why people might be selling something, but what trend following allows us to do is try to capture predominant periods of those trends in particular. Say coming out of this level in particular of 2020, well, imagine, if we've been able to buy it at the lows of 2,200, 2,191 or so, and sell it all the way at the highs of 4,800, that's an amazing trade. But at what point was that the reason for doing so? What was the bearish versus bullish thesis at those moments in time versus, say, after we had reclaimed a 200-week moving average, or maybe even reclaimed a 20 or 50-week moving average? Say if you just simply was long above the 50-week and in cash or safety assets below the 50-week, well, maybe you were then able to be a buyer at 3,000 and a seller maybe around 4,400. You were still able to capture the predominant amount of that move in a risk managed sort of manner, a way that has a reason that we can replicate when having positions put on or taken off during that period of time, without having to worry about the broad-based macro components and what is driving the narrative of the market at that point in time versus the price itself. That being said, I know I've been going for a bit on the top-down approach, and as I mentioned, that is not the only approach to doing so. I mentioned that the stock market is a market of stocks, so we can take more of a granular bottom-up approach. Jonathan, anything you wanted to add to that mix?
Yeah, this is a fantastic analysis when we start thinking about this broader perspective of what is happening in the markets and what are we thinking about, or what are we seeing with regards to the S&P, for instance, or it's called intermarket analysis, where we're using rates, we're using gold to try to understand the markets. And if you still looking at that prior chart, what we notice, I went to dinner the other night with some friends, and what one of them was saying, oh, with the market crashing currently, it was like, are we looking at the same thing here? We need to pull up a chart. Let's actually visually represent it. And then so their concept of or feeling was, well, the market's been in this crash state. And I think a lot of people aren't paying attention. They aren't looking for these moves, and they can have that sort of fear. And if you are focused on the chart, it will tell you, hey, this is maybe a green light, yellow light, red light type environment, and I can adjust accordingly. What oftentimes top down is doing is just using that and saying, I'm staying in the market. This is giving me that confidence to maybe add to positions, maybe in weaker environments. I'm setting up more cash, I'm waiting. There was a question that came in to the Q&A asking about, hey, is technical analysis useful to the investor rather than the short-term trader? And the argument, of course, is that anybody can use it. It's just a different process. It's the difference between flying a plane and driving a car, right? You need to be paying very close attention. Even if you have cruise control on, you're watching your environment constantly. In the plane, you can kind of hit that autopilot, right? You can wait around a little bit, wait for things to adjust or something to occur, or we get close to our departure point, right? We need to think about that concept of what my strategy is, and I'm just adjusting for those signals. I'm waiting for technical indicators to give me the signal to tell me if it's time to move on, or if it's time to adjust, or it's time to find or enter into, for instance, that gold chart that had been waiting over a decade to re-hit that same level before finally taking off. We can start to use this for those entries, exits, risk analysis. So I'm going to go ahead. I'm going to replace here. I'm going to go to screen, and I'm going to go and grab Fidelity.com, because we're going to take the other road now. We're going to go back to a more tactical process of thinking about what's called bottom up. So bottom up takes a little more work. You yourself, you're able to pull up 4 or 5 charts there and view what was going on at the broader markets, and again, giving you some of those themes. What a bottom up trader, this is how I was trained. I was actually mentored. That's who had won the World Investing Championship. If you've never heard of this, it's literally where the people put their money in the market, and they say whoever gets the highest return wins the contest. And that's exactly what their process was looking at really hundreds, if not thousands, of charts of individual stocks and then building from that. And so if that's something you want to spend that time and that will and skill that you might have from doing that, the bottom up process will give you, once again, you're looking more at the trees than the forest. What Andrew was doing, he was looking, and we're ignoring all of those little blips on the screen, aren't we? We're using trend to say, we don't worry about that. We don't need to worry right now. We need to wait until the market tells us what to do. And so a bottom up would look directly at stocks. They would start here on something like news and research stocks, and you can see individual securities. Some of you have already throwing out some symbols to look at. A lot of things like this on our list. Orders by Fidelity customers tell us a lot of traders are interested in these ones today specifically. Probably the common ones that you'll see over and over and over again. Those big names, you see them all the time. NVIDIA coming up with earnings. A lot of you have some questions there. We'll look at the chart, of course. But I want to sort of think about this process and say, if I just go and look at what's called a screener, what's going to happen when I pull up stocks? Am I looking at pulling up, let's see, 9,574 positions, Andrew? Is that where we should start? We need to do that every Sundays, watching football. I'm going to go and scroll through 9,000 charts? Absolutely not. That is not what this process is. You need to have a manageable amount, and you need to have, again, signals and things like that to utilize in your process. So some people might use market capitalization, for instance, understanding the risk in that trade. We can see just by clicking mega cap, I've got those big names. There they are in the trillions. We got Google, of course, Alphabet, Meta, Amazon, the Magnificent Seven, as they've come to be called. Great sort of proxy for understanding what's going on in the mega large caps, right? These are called mega caps now. But you can see 31 that are fitting into that. We can expand that out. We don't need to just limit ourselves. We can go and start to see that in the smaller and mid cap, the vast majority of those positions are actually in that level. There's opportunity there. This is very much in that sort of, I know Peter Lynch was something that Andrew and I have talked a lot about, and something that we reading all of his books and understanding his process, which was turning over the rocks and trying to find as many opportunities as possible. And the only way to do that was to turn over the rocks, right? Keep looking, and you finally find those opportunities. If you're the one that's finding them earlier than others, there's opportunity for what's called alpha. But you need to have a process, you need to be consistent, and you need to have technical analysis to tell you a lot about the entry and exit signals. So I've reduced that down to 1,220. Still too much for me, too much of a too much work. I don't want to have to do all that. We can see that there are other things like sectors and industries. I'm not
Jonathan there. So always fun when we get something like this live happen. So I will pick up where he was moving in that respect. I'll grab the screen one more time. We'll take a look at that same sort of component that he was just going through. The same idea of using a stock screener, essentially a way to whittle down pieces of information along the way to then use it for that same component of the market as far as finding individual stocks. Jonathan, I see you coming back on. Anything still working on your end?
I think so. I may have kicked the cord underneath the computer. Don't do that, people. Stay still. There you go. All right, let me try this again. I'll continue that thought. Let's see. Seeing everything? Perfect. Crisis averted. Appreciate everyone's patience there. All right, I'll continue this thought. We did add sector, industry, sub-industry to our list. I'm going to come back around to this. This is important to the bottom-up process is knowing how the company makes money and where they might fit into that in terms of their the trades that you're putting on. In addition, you already mentioned Andrew was talking about moving averages. He was talking about the process of trend when making decisions. So guess what we have here on our screener? I can actually go into technicals. I could do something like look for price above that 200-day, that long-term moving average. And I can start to screen appropriately to try to say, I want stocks that are showing that bullish trend on the longer term. I can add and adjust and remove and do whatever I need to do to sort of kind of bring things back into the fold. But I'm just going to do this just for clarity. Once again, this is not my specific process. I'm doing this for simplicity in some cases, just for I know a lot of you, this might be the first time you've seen this page or some of these concepts. So by all means, this is not going to be the way to do for everybody, right? This is just one way to think about this process. I do like this as well. We can sort of see when we click on our 200-day moving average, price above, I can also see that universe of stocks and basically where this is sort of the median zone. You can see somebody over here at 342% above their current 200-day moving average. That's not too bad, but once again, that's already occurred. We can zoom this in a little bit and we can start to find out, once again, as I've added these, it will allow this to then just screen for those positions that are showing in that zone or in that level. We can now see that that's added way over here. But by sorting, I could go in through and see something like some of these stocks that are already well above their those levels. Once again, remember, I've added in additional market capitalization criteria here. Going down, I'm going to add one more thing. You talked about it. A lot of us aren't financial analysts. A lot of us can't argue with the Harvard-educated analysts that are out there that are meeting and going to these companies. One of the things we actually do add in can be something very simple, such as like our equity summary score, which brings about some analyst opinions that are amalgamated into one easy-to-read score. I like doing this just for adding that additional sort of threshold component. Some of you might say, I'm okay with bullish, very bullish, but just for speed's sake, we've brought that almost 10,000 down to a more manageable 53 securities. And those are the things that we're maybe thinking about when trying to find some of those opportunities out there, is creating those thresholds, bringing that down to a manageable amount. And now we have that bottom-up analysis we can use. And I can look at these and I can say, what in the world is going on? What are some of the top performers in terms of the last, again, looking at the 200-day moving average, for instance, utilizing that equity summary score, utilizing a market cap threshold, I can now go in and see some of the sectors and industries that are in those top performers, right? I've started to move towards what Andrew was doing from the top down, where he might look at something like the sectors that are performing well in certain some market environments. And instead, now what I can do, and I will come back around to this again, like I said, we're going to be in the middle. We've got right now, I can start to see healthcare providers and services in those top names. What might be going on? Maybe I can find some themes that are interesting here. I can start to then dive into some of those names and I can pull up those charts and I can start to analyze them and start to think about where they are in terms of trend, where they are in terms of something else we'll talk about, which is momentum. You can zoom in and out to get some of that understanding. And it's an interesting chart, right? You can start to then go in and do something like indicators. I'm going to do a moving average crossover, which is going to think about the multiple types like the 20, 50, and 200-day moving average. And what these will do is allow me, I can see the bottom of my screen there. There you go, apply. This allows me to add those very quickly to see how price has been performing in that recent time period. And you can see it's not all roses, right? Prices don't just move up, but those are the things that we're looking for, are those signals, such as a 50 crossing a 200, giving me an entry and something called a golden cross in terms of trend, waiting on that exit signal, and it hasn't flashed yet. Those are the things that bottom-up traders are starting to run through, and we'll get into maybe ways to think about diversifying that to other parts of that industry or maybe to that sector. So without further ado, I'll get it back to you there. Andrew, I know you were going to talk us a little bit about sectors. We will also, of course, get into a few of those big names here at the end, so don't want to leave people hanging. I'll get into some of the those big name charts. We'll do that at the end. So the bottom up process, we're not leaving it behind. But we're going to go back to Andrew. He's going to talk to us a little bit more about maybe ways to think about this column, that sector, and some of the momentum and areas where we might see outperformance.
Yeah, absolutely. And like you mentioned, we've looked at it through that technical lens now. But, I mentioned the maybe drawbacks of fundamental analysis, but it doesn't have to be either or. It can be a little bit of both. Maybe you are someone who is maybe a little bit more fundamentally inclined, at least from your perspective of understanding the companies and the stock picking style environment, but we want to use technical analysis maybe to some degree in our risk management, in our timing components to feel better about the trades that we're making. So what if we combine a little bit of this? And what if we use macroeconomic components of understanding sectors and what the business cycle is at different points in time? And you can actually do this on that page that Jonathan was looking at as well. News and research. If we go to markets and sectors, there's a variety of different components here. The first one I want to spend some time on, though, is sectors. And the first component of that is the business cycle. So again, this is a larger component of macroeconomic research, and you would call it really fundamental research in that respect. And essentially what we look for is the component of what business cycle are we currently in. And what do we mean by that is that if we understand that there are, recessions, and then there's large expansions in the economy, and there's stages of that expansionary phase, where do we currently sit? And it looks like our analysis is the Fidelity Institutional. This is available for everyone on fidelity.com. And they are saying that we're roughly in the late term expansionary phase. And I believe that's actually come down to some degree of where we've been at in prior cycles. If we look at the United States, we can see that at one point it looked like we were in that contractionary phase, but maybe we have come back into that late stage phase to some degree. And then from there, we can look at those business cycle components. What tends to do better? And I always am very cautious in that phrasing, in the sense that if we see these plus signs here, ones that tend to do better in historical business cycle versus ones that tend to do worse in historical business cycles, what do we mean by that? Well, the biggest thing that we have to remember is that, one, these are tendencies, in the sense that just because it has tended to happen in the past does not by any means mean that it has to happen in the future. There are always idiosyncrasies to individual components and cycles in that respect, but we look at what things tend to do better, and we can kind of think about that intuitively, that if we're thinking about maybe a recessionary cycle, well, information technology doesn't tend to do as well. Industrials don't tend to do as well. And the kind of components of real estate don't tend to do as well, because people don't generally have that excess spending in those recessionary environments. They aren't going out and buying new things quite as much as they would be. In that same way, what do people still have to spend money on in a recessionary cycle? They still need groceries. They still need healthcare. They still need to pay their energy bills. Those are still companies that at least have outperformance in those periods of time. And again, the other side of what I was going to say, outperformance does not necessarily mean positive performance. So if we are going to be sector traders and always having a certain amount of allocations to every sector, one component of that means that we're always long to some degree. We don't by any means have to be always long. We can move to safety positions. Cash can be a position during periods of time, but given those environments, say if you are someone looking for those types of trades, well, if we're in that late stage, those consumer staples and the energy areas and ones that we've seen, we can see first how those sectors are comparing to one another in the comparison of their individual parts. So say for one, if we're comparing, say, the real estate sector, one of the plus signs on the late stage cycle, just to back up, what am I looking at here? All of these lines and funny things on the chart. First and foremost, we've got just a chart of whatever sector we're looking at. The real estate sector was the first one that I had picked here, comparing that to SPY as a proxy for the S&P 500. And then we've got a relative strength comparison indicator here. What is a relative strength comparison? Well, it's essentially comparing these two charts in essence of if we were long one and short the other, essentially trying to capture the gap in the performance of those two. And you can see that for a period of time, this was overperforming the S&P 500, started underperforming, and has started to at least mean revert back to the mix. So we've seen the strength come in on that real estate side in the last few months. In that sense, we can see that maybe there is performance starting to try to generate in this level in particular. Another one that was mentioned here, consumer discretion, or I'm sorry, consumer staples in that mix, that it was having underperformance. And then in the recent period of time, during this most recent kind of downturn that we had in the S&P 500, it did not nearly have as much of a downturn. And that's what's created this kind of mean reversion back to these levels in particular. Same thing, though, can be said on something that wasn't in that chart of the same sort of nature, that XLF. It has had performance, but is it starting to wane? We've seen this relative strength starting to kind of top out in that respect. And why does all of this matter? Well, the component sometimes is if we're looking for other opportunities out there in the market within these sector components, that again, we start from the top down. What is the business cycle? What are companies and our industries and sectors that do better in different business cycles? And then maybe within the confines of what Jonathan was showing, what companies are doing well within those sectors. And now we've created a list of companies that we can then do additional due diligence on. Again, though, why is this something that traders gravitate to? Well, it's a kind of an old saying in that respect that, well, hey, if you want to beat the market, how do you do that? Well, you own stocks that are beating the market. It's that simple, of course. And, as everyone's probably rolling their eyes to some degree. Of course, it is that simple. And that is what everyone is trying to do. But how do we find companies that could be beating the market? And to do so, we have to find companies that, one, potentially have trend in the favor at that period of time. Maybe we are strictly looking at the granular component of their chart in particular. But then also, what if we're looking at ones that have those prevailing tailwinds in their favor of a business cycle that tends to do better for that company in particular? Maybe we're also looking for names in particular. If we're thinking about consumer staples as a mix, what is a commonly held consumer staple company? Walmart. And we can pull up a chart of Walmart to see if that is a component of what has been happening in the broad markets at this moment in time, and see if that's something that also then speaks to these components of the market. Now we also see a chart that has been in a strong trend for a period of time. And now we've whittled down a list of maybe a handful of companies. By no means is Walmart the only company in the consumer staples mix. And during this period of time, it's had strong trend. It has had strong accumulation during this period, higher highs and higher lows, and acceleration of those higher highs and higher lows as well. If we go back to the long-term max amount that we have here, and we see it's at all-time highs. It has continued to move higher here in the last few weeks, have been beneficial for shareholders of Walmart in particular. But again, there's a variety of ways to combine all of these components. Anything that you wanted to add next to the mix there, Jonathan?
Yeah, again, we're getting into some of those themes and the processes of reading the broader markets and understanding the economic themes, and what we call, again, referring to as inter-market analysis, and understanding that if inflation, who is better set up for inflation, or who's better set up for low interest rate environments. And so all of these things can play into the decision making that you're using. Andrew and I, we tend to focus on the charts telling us. Institutions and traders are often trying to get in front of this, and they will often give you those signals early if you're paying attention. And the signals are what we might use for something like a momentum, or we might be thinking about that trend, where trend is starting to shift or change from a period of where it wasn't really doing anything in some of these cases. Walmart, as we saw here, 3 or 4 years of sideways, what we call sideways price action, where it's not as much as there's ups and downs within there. If you're thinking about this as a long-term investor, you're probably pretty bored for a little while. You may be collecting in some stocks, you're collecting dividends, you're adding at least to your bottom line return. But it can be difficult when at the same time we might be seeing other sectors and industries that are sort of booming and flying. One of the things that you should, again, as a top-down investor, what you might want to be thinking about. So I'm going to bring back up ActionTrader Pro here. Go ahead and share. Go ahead and start showing something like the ability to run through a list. These are the sector spiders. As you can see, they have S&P in there. These are the different sectors that you might have pulled up. And I just have a chart next to it. Very simple, very easy to spend 5 minutes thinking about some of these things. What's financials doing? Boy, breaking out. Are you not paying attention to what financials have been up to? Where we're looking at consumer discretionary. Very different, right? Not seeing that sort of breaking out or pushing to new highs there. And that we can just go down that list and start to think about the risk reward and the process of looking at trend and trying to ride that trend for as long as possible. Andrew and I always use this term, the trend is your friend until it ends, right? And so we try to be friends for a long time here. You try to stick with it until it gives you the signal that says things are starting to shift or change. The hardest parts are when you've been in this trade, if you're looking at it and all of a sudden things start to pull back, you have to make decisions along the way. That's where trend lines, it's where having things like signals, alerts in place to keep an eye on what the markets are doing. But this is a way to do that, and look for things like momentum. And somebody asked about this in the questions. What are some things you use? Yeah, relative strength, RSI is a way to think about price action and to see if this thing starts to break above and starts to get some momentum building, like you see right here. Well, that could be a entry point for us. That could be something where we see these sort of huge moves, and we're going to wait, though. We have to wait and see when that starts to show up. This is another thing that we can actually use in that stock screener that I showed earlier. This is part of that process, and a lot of people, again, find themselves late to the party. We want to be early. We want to be adding when the first breakout and the first signals start to occur, not chasing something in what's referred to as an overbought zone up here. And so we would be looking at these things or looking at divergences. There's all of this that is part of the technical analysis guidebook that you need to be aware of, right? Or these sort of concepts. And that's what something that Andrew and I do in our morning briefings, or we do in our 4-week classroom, where we start to take people through this process. So traders will start to look for, once price continues to push higher and maybe hitting new highs, and it's not doing so with momentum behind it, that's a signal that says we need to be careful here. And then when those signals start to flash, that's where traders, dependent on their time frame, may need to make adjustments. As you can see, we can maybe zoom this out, and your threshold might be very different. We got a lot more noise, a very different look now. I can flip something like this to a weekly chart. Andrew was showing some earlier, and they're very different in terms of their process now. The calculation is different. We've zoomed out. We're looking at it from that 30,000 feet now, whereas we were looking very closely under the microscope. So now we can start to, again, change our decision and change our process. But we can't make decisions short-term when we're a long-term trader. We can't make long-term decisions when we're short-term traders, right? We need to make sure that those fit with our process and strategy. All right, so we come back around. Let me go back and to kind of finish some of the thoughts that we had in terms of the sectors and industries. The industry specifically, I talked about tenant healthcare. We did the stock screen. It was top on the list for price above that. We saw multiple healthcare providers and services show up on this list. We see pharmaceuticals, biotech. So we get a little bit of feel that healthcare has had an interesting move, and specifically some of these industries. Sub-industries get a little too granular. You got to remember these could be very small. Some of these will have only a few symbols or securities in there. So you got to be careful about going too far down in terms of here. We may be looking at, generally, I think industry tends to be a little more of the sweet spot when doing that. There are other multiple ways to also think about finding some of the things like industry ETFs that allow us to get exposure. But if we're backing this one and we're getting in, we got to remember that the risk might not fit in with what our trading strategy is. A bottom-up analysis doesn't mean you have to buy the individual security. It could mean that you are now looking and saying, there's an opportunity based off of what I'm seeing in some of these stocks to then invest in an ETF that fits in with that strategy. So let's go back. We see now we have an ETF screener. Earlier, we were talking about stock screener had almost 10,000 securities in here. Now we can go in and see things like objectives and exposures. And we see that we can choose things like country, sector, industry, and market cap. I'm just going to choose industry here. And then let's go back and just for a reminder, healthcare providers and services was the one we were looking at. You can see a long list, how many of some of these have within them in this area, healthcare providers and services. Don't be daunted here. 1,336 seems like a lot, doesn't it? That is not what we can see is that there is a spectrum. Healthcare providers and services, how much of that holdings are in that industry start to show up. And you can see that after the first two, quite a precipitous drop off in terms of exposure to that sector or industry. But we really have these two to kind of pick from to say, I want to see about investing in this. You can see one of these has very different sizing as well, 86 million in net assets versus 781. Either way, I'm just going to, again, click on the top one. You want to think about with ETFs, and we do a ton of ETF content, don't we there? And so we want to think about the expense ratio. We think about the actual holdings, what we're getting into, even though those two seem to be very close in terms of their strategy, in terms of what their holdings are, there can be big differences in terms of the cost of holding this or the process of what it is actually holding. Maybe there's a oftentimes there may be a difference in terms of the percentage. It seems like the top 10 are spread across in about this 2% across these names. We don't even see the name, of course, that we were pulling from that list. So this may give us more opportunity to go back and look at some other charts. Say, what are the people running this ETF? What are they seeing here? Can I look at a few of these and get some ideas and think about that trend and some opportunities that come from that? Again, that bottom up analysis we are moving through and starting to think about something like this ETF, which is giving us sector exposure. We can see now we can start to do some of those same things. We can find, just like we saw with some of those other ones where price had been somewhat what's called an abasing pattern. It had been kind of sitting there for some time in the same area. Going back to January, we saw that it had just sort of oscillated back and forth before finally breaking out. Andrew, I know exactly what he's thinking about. He's saying, we've got resistance that turned into support. This might come in handy because a few of you were asking about resistance on a few of those big name stocks. This is something we're always looking for, are the transition between supply and demand, where we might meet a supply zone. This often turns into a demand zone. Somebody told me one time it's a lot like ice up there, right? Where you start to utilize that as your support, breaking through the ice. It was actually Andrew that brought it up, so maybe he can do his ice spiel. But this sort of process of finding these securities, now from that bottom up process, I can look for entries and start to say, maybe if this thing is able to get above a certain level, I'll start to utilize it. If you are interested in technical analysis, Chart Plus has some really cool tools, things like Classic and indicators, where it'll actually look for and give you some concepts of, prices crossing above the 21 moving average, or we can see here that we have a triple moving average crossover, which is in green, telling us this is often a bullish event. You can use technology now to your advantage, can't you? You can try to allow it to go out there and find things like support and resistance for you. There's your resistance. This is, again, utilizing Recognitus tool to find areas where we might see that. This is, somebody asked about volume profile. This is often utilizing some of those same things, areas where traders are setting up sort of demand zones where we might see a lot of traders invested and waiting on something to provide support. Other areas where we might find resistance. If price is able to get above and hold, that's often a good indication that we may see price kind of break out to some of those new highs. We always want to be thinking about our exit plan. That's something Andrew, again, as we're running into our time here, want to be thinking about. But we've now sort of done this process, right? We've thought about the sectors, we've thought about the industries, the overall broader markets. We've gotten into some of the basic securities that are out there. We need to be, of course, now we'll do a little bit of a quick chart run through, Andrew. I think would probably be a good way to sort of finalize this. Talking about the concept, though, of exit strategy, I want to give you a minute here to do that. This is imperative. A big part of what we do on the trading strategy desk is say, sometimes the easy part is hitting the buy button. It's the sell button. It's the getting out. It's the oh, this trade turned into an investment that I'm now going to hold and I'm losing money on, and I don't know how to change my mind. I don't want to tell myself that I was wrong. Andrew, any thoughts on exit strategy before we pull up a few individual charts?
Yeah, absolutely. Like you mentioned, I think the exit strategy component of technical analysis is really the biggest beneficial component of being a technical trader, is because we have to remember the value of a company from a fundamental basis is simply what we're looking at on paper. The value in our account is going to be determined by the value of the shares in the marketplace. And that's what we ultimately are trying to grow, is our account size at the end of the day. And to that degree, we use technical analysis to be reactive in the markets. We're looking for periods where the accumulation is no longer taking place with respect to that. So I've got my chart on the S&P 500 up. And the main thing here is just looking at it through that lens of where would be an area where we can observe that accumulation is maybe no longer taking place? Are we entering into a mix of distribution in that respect? We mentioned it earlier, that 50-week moving average as a concept that was back in 2020 and coming out of the 2022 cycle. In the same way, if we're using that same sort of approach, we're looking for periods where it makes sense to be long, or maybe it makes sense to not be long. Maybe if we prefer to be a long only trader, well, we can have the approach of being long in prevailing uptrends and just getting out and being in safety positions in prevailing downtrends. And what is the benefit potentially of avoiding that drawdown risk, or especially on individual stocks, avoiding kind of quote unquote the big one, the one that has a harder hurdle to get back above. I always feel bad picking on stocks that have potentially been in that mix over the last few years. But one quick example that I saw come in as a request was Intel. Over the last few years, Intel has had that indistinguishable component of distribution that we've seen selling and supply enter the mix, especially with respect to this most recent area. But during this period of time, what ended up happening? We've spent basically the entire part of the last 3 years below all of its major weekly moving averages. This 200-week moving average, which it did have a peekaboo above, and maybe that drew some traders in, but their bullish thesis, at least in that scenario, became invalidated on that break below. And where did it start to see an acceleration afterwards? It was right as we broke through those levels in particular. And to the analogy that Jonathan was mentioning, that I kind of skating on a lake of ice is the way I tend to think about support and resistance, especially from the support side of things. Because imagine if you're out there skating on a frozen lake, well, the ice is supporting you through that period of skating. But if the ice breaks, that's going to be the thing that is keeping you down. The ice itself becomes a component of resistance that has to be broken from the downside. And in that period, we saw this happen essentially right back to this $50 or so level that had been supportive during that period of time. So in the same way, if we pull up NVIDIA, that has been a hallmark of an uptrend and a hallmark of an explosion higher over the last few years. And how do we then think about holding onto a position, if we've ever used the phrase buy low, sell high, if we're at something that is roughly at all-time highs, how do we have a position in that respect? Well, we have to use some component of a trend following system. In that sense, if we were looking on a weekly basis, you'll notice that 20-week moving average has been supportive along the way. And then that case, it maybe allows you to stay within a trade if it's above that, and maybe you look to manage risk if we're back below it. In fact, we got this move down below it, and in that period of time, maybe you missed out on a trade for the next week, but at the very least, maybe you're still looking at a bullish thesis in that respect, as long as trend remains intact, as long as the components remain truthful in that respect. The analogy, the quote that I always like to use in situations like this is that old Peter Lynch quote, that we want to treat a portfolio like a garden. In essence, we want to water our flowers and we want to cut our weeds. We want to allow trades that are working out in our favor to continue to work out in our favor. Ones that aren't, we want to get them out. We want to avoid that drawdown risk to the best of our ability. And a lot of the time, traders, we kind of take the opposite approach. We're quick to take profits because we like seeing the green in the account, but we are slow to take losses out of the account because we are afraid of them becoming back to gains. And imagine having to take a loss on something, a week later it's back at your cost basis or higher. Of course, that is the situation for a lot of trades out there, and I've been in that boat plenty of times myself. But at the same time, we want to avoid those components of drawdown risk. Another company I always feel bad picking on because it's one that we use daily. It's a ubiquitous part of the broad markets at this period of time. But imagine 5 years ago, 4 years ago, I guess, you say that, hey, Zoom is now trading below its 2020 opening, and roughly, I think it's recovered here in the last few weeks, but it's still roughly below where it was at pre work from home, pre everything that Zoom uses nowadays. And in that case, we would have had to have some sort of risk management along the way to show us that that accumulation phase is no longer taking place. Maybe eventually we start to see accumulation again. Maybe they change here, but it has given us periods of time where it made sense to be managers of risk along the way. No, we're already right at our pre-described time, though. Anything that we wanted to take a look at next before we wrap up, Jonathan, or anything, Trey, that you want to look at from a housekeeping perspective?
Well, I'll reiterate what we do is we do this all day long, right? We pull up charts, we pull up the broader indices, we look at what's going on across commodities. This is what we do as trading strategy desk, but we can't always fit it all in to this hour. It's always as much as we can. So thinking about that, we do have our midday and our afternoon market briefings. In fact, today, special treat, of course, as always, our good friend Robert Kwan will be in there, and he spends the time to analyze these securities in depth, looking at it from a technical perspective and talking about the narratives. Also, the earnings reports coming up on NVIDIA. We'll have a lot of content tomorrow morning. I know, Andrew, you'll be in our morning market briefing. So that'll be one of those things where we'll start to analyze these big events coming up. So join us for that. Really appreciate all your attention. Once again, it's always fascinating to me that you spend your time with us doing these things, learning about them. We enjoy it. We're passionate about it. I'm just glad to see that there are still people who are interested in taking some of this knowledge and trying to apply it on their own, even if it's just dipping your toes in the water, skating on the ice out there. It's one of those things that we're, again, appreciate your time. And Andrew, I'm sure you say the same. We are at time, though. Trey, anything yet to hit as we close up?
I just wanted to say thank you to Andrew and Jonathan for joining us and delivering a great presentation here today. As I both mentioned, head over to those coaching sessions if you want more market updates and briefings. You can click the button below the viewing screen or head to fidelity.com/coaching. So lots of great material out there. But with that, we will close it up from here. Thanks again, everyone, for joining us, and we'll look forward to seeing you at the next one. All right. Bye-bye.